Hello, everyone, and welcome to Public Live. I'm your host, Anne Berry, and I'm with you here today to discuss the recent banking crisis. Feel free to check us out on Spotify at The Public Podcast and on YouTube at Public Invest for in-depth interviews that help you keep your portfolio on track. Today, we are here with founder and CEO of the Macro Compass, Alfonso Peccatiello, to talk about the recent bank instability across the US and Europe and the potential risk facing the global economy. Alfonso, welcome to Public.
Hey, Anne, it's a pleasure to be here.
Let's talk, even as we are seeing regional banks here in the US continuing to look like they need some lifelines. Throughout the week, banking instability fears seem to have calmed after the UBS $3.2 billion acquisition of Credit Suisse, after Treasury Secretary Janet Yellen assured that officials would continue to assist banks with extended deposit insurance if needed. And we have seen banks like JP Morgan and Bank of America step up in the case of First Republic to try and lend some support. So, Alfonso, what's your reaction to all this?
Look, Anne, we are facing banking stress. It's a liquidity situation right now. So we have certain banks in the US which have mismanaged their balance sheet, which means they had a very concentrated deposit base. So a lot of risk of all these deposits running away all of a sudden, like it happened to Silicon Valley Bank. And at the same time, they didn't have enough good quality liquid assets to meet these outflows. So what they had to do was basically fire sale these assets to try and raise the liquidity to meet the outflows. In some case, that made them insolvent. Now, there is a lot of hysterical reactions, I think, going on out there, trying to extrapolate this into a systemic liquidity crisis for the banking sector. And there I have to disagree with that. The reason is simple. Look, the Federal Reserve has set up a facility which basically now guarantees that banks don't need to fire sale anymore their treasuries, their mortgage-backed securities to meet outflows. They can just lend them to the Fed in the new facility without any haircut whatsoever and get back the funding to meet potential deposit outflows. So that means that mechanics where you are forced to fire sale your assets, it's not there anymore because now there is an alternative, which is posting your treasuries or your mortgage-backed securities at the Fed. Now, said that, so setting the stage for this non-systemic liquidity crisis that I expect, because that's not going to happen, we should reflect on what does this banking stress actually cause for the medium-term macro implications. And that is much more grim, in my opinion, because the amount of credit creation, the lending standards were already tightening before this credit stress. And now we have a situation where obviously banks have gotten a scare. And during scary moments, you don't expand your balance sheet, you don't expand your lending, you try to be defensive. Being defensive for a bank means lending less to the real economy, and there are already sectors like the real estate market which were under pressure, and the less credit you throw at these sectors, the more pressure will build up over time.
Alfonso, let's talk a little bit more about how the way in which the regulators have stepped up may or may not have mitigated the risk that you just talked about. You just unpacked for us, and very appreciative that you did, the way in which the Fed is trying to create liquidity in the system and help these banks through duration mismatch between their assets and liabilities. Have they done enough? Do you think that they've done the right things quickly enough?
Look, over a weekend is never easy to try and engineer some solution to quite a problem. I think they have done pretty well. Look, the key of our system, Anne, is that it's based on credit expansion. We lever up more and more. We do more mortgages. We do more loans. We accumulate more debt. Now, all the system is based on the presumption that the collateral value remains stable or it increases over time.
Right.
Now, the collateral value, for instance, during a crisis like 2007, 2008, the collateral behind most of the lending was house prices in the US, right? It was basically predicated on the fact that US house prices could never go down. And that means you can take more risks. You can do more leverage securities, more of this weird structure we created behind the very assumption that US house prices, the collateral could never go down. You see that when the collateral loses value, then something very bad happens. It's a deleveraging of the system, which is pretty bad. Now, what the Federal Reserve has done here is to make sure that treasuries, which are considered one of the safest collateral in the world, do not go down too much in value, but there is a facility that effectively guarantees the stability of the value of that collateral, because you can post these treasuries at the Fed. And I think that is quite a powerful thing because, as I said before, it stops this fire sale mechanism of treasuries that could lower the value further.
Yeah, Alfonso, there's one part of this which is expectations of valuations over time. That's core to how some of these risks get created or mitigated. And then there's also rules of the road. And one of the rules of the road in finance that's been around since the dawn of the system has been that that debt gets paid off before equity gets any capital. So with that, just to frame the discussion, let's talk about what is going on with Credit Suisse. Swiss regulators decided to write off, literally means just for the community's benefit, taking the value to zero. $17 billion worth of Credit Suisse bonds while not wiping the value of the equity. I mean, there could be very little equity value left, but the point is that the bonds have been written off on a regulator's edict. Talk to us about how that could affect confidence.
Look, that's quite a decision from Swiss regulators because,
Right.
as you said correctly, and in a normal waterfall, you get equity being wiped out first, and then only later you proceed into the riskier bonds, for instance, the additional tier 1 17 billion bonds that you were discussing. This time the waterfall was not respected, it was actually reversed. So, look, how do we handle this? This is the Swiss regulator. So here investors have been very quick in extrapolating that the entire European additional tier 1 market could be basically wiped out, because why would you take the risk in investing in these securities if you're going to be wiped out before equity holders are going to be wiped out, right? Again, I think this is a very idiosyncratic decision that the Swiss regulators have taken. I do not agree with the decision, let's be clear. But in Europe, you have even different regulation that avoids in the first place the chance that these bonds can be wiped out before equities can be wiped out. So again, a very idiosyncratic Swiss situation, which I do not agree with, but this was more of a political decision, I believe, Anne, because you can penalize at that point the equity holders, and Credit Suisse had a lot of Arab investments coming from the Middle East when it comes to the equity owners of Credit Suisse, while effectively the bond owners were institutional investors, mostly from the West. So you had asset managers, PIMCO, Allianz, etc., owning these bonds, right? So the regulator in that case preferred to sweeten the deal for UBS and for the shareholders of Credit Suisse while penalizing the bondholders. It was also a political decision based on who the investor was, I believe, and the regulation in Switzerland allowed this special treatment. This is not the case in Europe overall. So be careful when you try to extrapolate as an investor that what happened in Switzerland can be valid in Europe as well overall, because that is not the case.
I just want to push a little bit, Alfonso, one thing you said, because actually a recent investor in the Credit Suisse bonds was a Saudi entity.
Yeah.
Right. So I just want to make sure that factually that was on record, just given the statement you just made. And the European Central Bank and actually the Bank of England both came out and explicitly said we would not have done what the Swiss regulator did,
Correct.
sort of supporting your point. Let's talk a little bit more about the US, Alfonso. President Joe Biden recently called for increased regulation of US banks. Do you think we need more regulation, or do you think we need to just take what we've already got and do it better and enforce it? What's your perspective on the next steps here?
Look, US regulation was not sufficiently tight, especially for small banks. Now, first of all, the definition of small is very funny because a bank of over $200 billion in the US can be defined as a small regional bank. To give you perspective, the third largest bank in Germany has a balance sheet below $200 billion. We're talking about the third largest bank in Germany. So $200 billion is not a small bank. It's a relatively mid-sized bank. And nevertheless, US regulation is very, very lax for this cohort of so-called small banks. For instance, and they don't need to stick to net stable funding ratio, liquidity coverage ratio, and all this regulation which has been enforced on large banks after the great financial crisis to make sure that their deposit base was sticky and their asset side was very liquid. Small banks don't need to stick to this regulation. Now, more than that, even large banks in the US are not subject to stress tests when it comes to the interest rate risk they run. In Europe, I've worked for a large bank for years. The regulator in Europe stresses the amount of interest rate risk that you take, which means your capital is stressed out in an exercise to see if interest rates rise rapidly, what kind of capital loss would you be taking in that move? Looking at the entire balance sheet of the bank, it's stressed overall against a rise in interest rate, and it's a regulatory requirement to run the stress test. That's in Europe. Now you ask him what's the US equivalent of that interest rate risk stress test, and the answer is there is none, even for large US banks.
Is that Alfonso, just again, just to sort of make sure that we're just on the technical side of it, is that when you actually follow the impact of interest rate moves have an impact on the pricing and therefore the book value of bonds. So even if the stress tests here in the US aren't explicitly interest rate driven as the input, are they not nonetheless derived from interest rate moves because they are in fact though based on bond values?
Look, first of all, banks don't take interest rate risk only on the bond book. They also do mortgages, they also do loans, they also have long-term liabilities on the liability side of the balance sheet. So there is a lot of focus on these held to maturity unrealized losses, right? Because that's what people are obsessing about. This was the problem at Silicon Valley Bank. They're extrapolating this is the problem elsewhere. The reality is you need to look at the entire balance sheet of a bank and stress both liabilities and the assets of a bank against a rapid rise of interest rate. And that's what we do with stress test in Europe. In the US, we don't do that. There is no explicit regulatory requirement to stress test interest rate risk, even at a large bank level. And then for small banks, we already discussed the lax regulatory requirement overall. So I think it can be improved. Long story short, it can be strengthened, and probably now there will be more focus on that aspect going forward.
Alfonso, when you look at the regional banks here in the US, and it's helpful the way you've broken down the relative sizes and what it means to be a big bank here in the US, do you expect there to be more financial difficulties when you look at confidence levels now and you look at the amount of liquidity available to these regional banks? Where are you now in thinking that we're through the other side of this?
Look, this is a very valid question, and because overall, although I do not think this is going to turn into a systemic banking crisis from the liquidity perspective, it is undeniable that now the path of least resistance is for investors to move their money towards the safest forms of collateral. So these are T-bills, because it's a liability of the government, not a liability of the bank. Money market funds, which are somehow basically implicitly guaranteed by the government or can only invest in government securities in the first place. Or otherwise large money centers, because of this dichotomy, right? If you're a large systemically important bank, you somehow are too big to fail. So the deposits in that bank are considered to be safer. And you're right, and this will dry up funding and credit for the small regional banks, which means they need to compete more and harder to attract these deposits, which will tend to shrink their net interest margin because they will need to pay more on the deposits to make sure they attract them, which obviously makes their cost of funding higher and it shrinks their margin. So in general, even if I don't expect this to turn out into a systemic liquidity crisis at this stage, I still expect long-term this to be quite negative for smaller banks.
Let's go back to something you said, Alfonso, at the top of the show, where you said the outlook now for lending to the consumer, and I would suggest also for small businesses, this commercial lending, is going to be a little more grim because banks become more conservative in environments like this and less willing to extend credit to the consumer, except when they've done real work to understand the strength of that consumer's ability to pay that loan back. Break that down a little bit more for us. When you think about the ability for members of our public community to go get a mortgage, to get an auto loan, what does this mean for them?
Look, a bank lends or tries to lend more aggressively when they have enough capital to attach to these loans, because by regulation, every time you lend, you're taking a risk on consumers. So the regulator will ask you to attach a certain portion of capital against this loan. In case you have a loss, there is some capital provision against that potential loss. And also, of course, when the conditions out there are so, as you said, that the economy is running strong, that the consumer has a good prospect ahead of himself, and therefore that it can repay back the loan with interest. Now, right now, we have an economy which is, from a rate of change perspective, slowing down compared to 2021 and 2022. We have a labor market which is not as aggressively hot as it was a year ago, maybe. So already from a macroeconomic perspective, you have a bit more of a conservative scenario ahead, let's say. And then on top of it, you have these regional banks which will now be forced to be more regulated, and more regulation means more capital that gets directed towards complying with regulation, and rather than using the capital to expand your lending book and your risks you're taking. So overall, by the way I see that, including the fact that funding will become more expensive on the liability side, that capital will be directed to meet new regulation, that overall the macroeconomic environment is not as rosy as it was a year ago, I can only see the amount of credit that regional banks direct to the real economy going down. That's particularly important because regional banks account for over 50 to 60% of certain lending flows to certain sectors, for instance, to commercial real estate or to residential real estate. They are very, very active in that space. If you dry up credit there, you might cause some damage to the real estate market.
Alfonso, you touched on the labour market not being, I think your words were, as aggressively heated as they were. We are, I think, technically still at full employment here in the US. Inflation has been tempered but not tamed. So what do you think the Fed's going to do right now? What's your projection for the rate hike path?
Look, it's been very interesting to see that many forward-looking indicators at a macro level point to a negative rate of change, a slowing down of the economy. But nevertheless, the labor market has remained pretty resilient. It's not as strong as it was a year ago, but you can't say it's weak by any metrics, right? So the best way to describe that maybe is that the labor market is holding on, and I think companies are hoarding labor. So before firing employees, permanent employees, companies are probably thinking twice, and because during the pandemic, to hire somebody back, it was incredibly complicated, right? There was a scarcity of labor. So companies are probably thinking, even if the economy slows down, do I need to fire permanent workers, highly qualified permanent workers? Can I not hold on to them, lower their work week, maybe lower their salary? You can see a little bit as wage pressures have come off, right? So wages are not rising anymore that rapidly, but they're not cooling down as well aggressively. People are not getting fired. It looks to me like a stasis, some sort of labor hoarding mechanism going on where companies are trying not to fire people. They're not hiring super aggressively either. They're just trying to keep their labor where it is because they're afraid they can't hire people back that easily.
Hanging in limbo, it sounds like, in the labour market from your perspective, Alfonso, for a little bit. That is Alfonso Peccatiello, founder and CEO of the Macro Compass. Thank you very much, Alfonso, for sharing your perspectives with the community here at Public Live. Thanks for tuning in, folks, and we will see you next time.